right, so welcome to class, everyone. If you're just logging in, you're going to see on my screen here, we're going to be going through quite a bit today. I would like to make sure you have access to everything you need. So I've left you a list. There are lots of forms we're going to be looking at today. I will put them on my screen, but if it's difficult to read on my screen, you'll have an opportunity to download them and save them for yourself. So make sure you do have that. I'll go back to this screen when we take our break as well, just to make sure you can get organized. It is quite a bit because we're doing a number of forms and schedules today. But we're going to start with review problem 8.2. So I'm going to share my screen, and we're going to jump into this one. Okay, and we have Darren. So we've been doing quite a bit with regular investments, non-registered investments, but this was our first chance to practice RSPs in a little bit of detail. It does get more difficult later, but just to jump into it, we have Darren. What I'd like you to do when you're reading the case of Darren is think about what the slips are telling you independent of what the client is telling you. Because a lot of times the case will give you information that your clients won't necessarily volunteer if you don't ask. And this is a good example, so I'm going to take it from that perspective. If I had Darren and he was a very quiet person, so he did not share personal information easily, I would take a look at the slips that he brought me, and right away I would have a clue that he's had some things happen in his year. We have a T4 for a small amount of money, considering how much he should be making in the type of work he does. And we have a very large amount of workers' compensation benefits. So I know before I've even spoken to the client that he had a workplace injury for a significant portion of his year. So right off the bat, I'm going to be thinking about all kinds of things. I'm going to be thinking if I need to ask him about a disability plan at work or a wage loss replacement plan at work, there may have been a small portion there that I'm going to have to deal with or adjust for. These are all the clues that we have. The forms are telling us what happened to Darren. So I've looked at it. I know he's got workers' comp. Workers' compensation is reportable but not taxable. We're going to add it to income, add it to net income, and then take it away from taxable income. It's going to go in two places on the return. I'm going to take a look as well at his T4, and I'm going to be extra careful to notice that I have to think very hard about my Schedule 8 and my T2204 because he's had an unusual part of the year. We'll be looking for overpayments or underpayments there. He does have some union dues. Now I know what questions I want to ask him. Oh, I noticed you may have had a workplace injury. How long were you off work? What happened? Maybe I'm going to ask him about medical expenses. This might be a signifier that someone who's not that old may have more medical expenses than you would expect for someone his age. So it opens the window into what happened in his year. All right, so then we get to the interview portion, and he tells us, well, I did have one good thing happen to me last year. I won the lottery. Wonderful, congratulations. What do we do with the lottery income? See a volunteer in the chat window. He won the lottery. Do I need to know anything about it? Do I need receipts? We're not going to report it. It is not taxable. So he spent a good chunk of it, which is great. He bought more lottery tickets. He went to Vegas. Excellent. Good for him. I mean, he made money on it the first time. Maybe he'll make more. Then he contributed $5,500 to his RSP. I need a couple of things now. I need to know what his deduction limit is. I'm going to get that from his representative client or from him if he brought his notice of assessment. Why might it not have been the best idea to put the money into an RSP? So I want you to think about a few things about Darren. His income wasn't that high. So Marisa, I'm noticing you've got, you're sending to private. So make sure if you're commenting that you're sending to everyone. So he didn't have a high income. So maybe RSP is not that useful for him. And Connie, that's the other one. He took money that wasn't taxable. He's put it into an RSP. He's made it taxable, and he's using up his deduction room, which might be more useful in a future year. Now, Can we do anything about the fact he's already put it in? No, that's happened. But we can educate and say the next time you win the lottery, here's the thing you could do with it instead. And this is why you need to think about that, because if he's a regular person who gambles recreationally, this might come up again in the future. So talk to your clients about income that isn't taxable and how you can avoid making it taxable by accident. And the second thing we want to talk about, which we're going to get to in the answers of the case, is maybe we're going to choose not to deduct all of it this year. I'm going to show you the return with it deducted, and I'm going to show you the difference if we don't deduct it and what that would look like, because I think it's important. So I've done this using tax software so that I can make very quick changes to it, but you, of course, will have done this with the fillable forms. When we get to the tax software, we're going to learn how to deal with these types of changes as well. All right, a couple more things. Let's answer some questions. Employment income, his employment income is from his T4, it goes on line 10100. Workers' compensation is from the T5007. It goes on 2 lines, so if you don't have 2 lines down for workers' compensation, you've missed one. I believe, because I just looked it up, it's 14,400, something in that neighborhood, and 25,000 is the deduction. So make sure you have 2 lines that you're going to report the workers' comp on. One portion is income, one portion is a deduction. And lottery winnings, he is not going to report. The amount of the lottery winnings is 10,000, but he's going to report 0 of them, and it's not going to go on a line anywhere. All right, what amounts can he deduct from his total income? Well, we have an RSP deduction if we want to put in an RSP deduction. We have union dues, we have enhanced CPP, and workers' comp is a deduction from his total income as well. Personal amounts are going to be the ones that we expect. He'll have his basic personal amount, CPP, EI, and the Canada employment amount. What effect would the deduction have on his federal tax liability? If you reduce your income, you reduce your federal tax liability. So that's good. He will pay less federal tax this year than he would have paid if he did not deduct the RSP. But then we get to the interesting question, which is he's working full-time and he expects to earn more in 2022 because he's going to be working the full year next year. So we know if he worked roughly half the year at 27,000, next year he's going to work the full year, he might get a small raise. 55 is what he's estimating. Would it be better for him to claim the RSP in 2022 or 2021? 2022? Absolutely, because he's going to have more income and more taxable income. Why might he want to report it this year anyway? What might be the reason why it would be useful for him to report it, even if it's not necessarily the best tax decision? It might be the best financial decision for him. Remember, he's been off work. Workers' compensation doesn't give you full income. He might need the refund now. He might say, I will take the loss and I want the refund now. So that's a valid choice. You know, it's his tax return. Give him the options and let him decide. So we're going to look at that together. And then calculate his 2022 RSP deduction limit. That one you might have found a little bit tricky, but essentially what you have to do is you have to look at how much income he had of the right sorts of income, and then you have to look at any other adjustments. So you're going to look for things like pension adjustments as well. In this case, he didn't have one, but don't forget to look there. All right, let's take a look at the return for Darren. So I have his personal information here, resident of Manitoba, yes and yes and no. Employment income, and 14.4, I did get it right, is workers' compensation. You will notice I do not have these line numbers memorized. Some of them I do, just because I've done so many tax returns. Some of them I don't, because they have changed in the last couple of years, or there are lots of lines on a tax return. I don't need that in my head. I do know that I'm looking at an income line, so I can find it on the page. So total income, 46,480. Net income, we're going to take off RSP, we're going to take off union dues, And then CPP, we're of course going to do a Schedule 8 for that. We haven't looked at these in a while, so I'm going to remind you, we need a box A. In his case, it's 12. Even though he didn't work for 12 months, he was pensionable for 12 months. Had he worked, he would have to pay CPP. So 12 goes in box A. Calculating here, 27.5 is below the maximum. We're going to take off the base exemption, calculate out what his actual contributions were, calculate what his allowable contributions were, and you'll notice there was a small overpayment. Well, not a small one, $95 overpayment. Let's get him the $95 back. So we're going to be using the figures from here. Okay, so all of those together, total deductions to get net income, $40,517. And don't forget to take off the deduction. Even though the government knows about this one, they will not voluntarily give it to you if you don't ask for it. So if you missed this line, he will pay significantly more tax than he should be paying. We can fix it on an adjustment, but it will delay how long it will take him to get his refund. So that's an important one to remember. The CRA will always add income in for you. They will not voluntarily add in deductions and credits. You have to ask for them. All right, so taxable income at the end of the day is quite low, $21,537. He's in the lowest tax bracket for sure. And again, just a reminder, why might it be better to save the RSP for next year? Well, next year, he's going to be in the second tax bracket. So this year, he's saving 15%. Next year, for the same RSP donation or contribution, he'll be saving 20.5%. So it's worth more next year than it is this year, as long as he can afford to wait to use it. Okay, so federal tax this year with the deduction in 323.0.55, and I didn't show you my Schedule 7, so I'm going to do that now. If we're going to claim the deduction this year, you need to fill out a Schedule 7. We're going to put the contributions in. He made the contributions in March to December. We're not going to allocate anything to a home buyer plan or lifelong learning plan. He doesn't have one to repay, so we don't need to put anything there. It leaves all of his contributions available to deduct. What his room is $8,500. His contributions were less than that, so he can claim all of it. And if he wants to claim all of it, we're going to say, that's what I want to claim. So on line 18, I'm going to decide how much I'm going to claim. And I'm going to say $5,500 there, and there will be no carry forward because we're using it all this year. So that's what his Schedule 7 will look like if we choose to do the deduction, and that $5,500 deduction, just a reminder, was up in the net income section. Okay. So for the rest of it, I would say the personal credits are hopefully fairly straightforward at this point, but I'm going to go find them for you. We have the personal amount, $13,808. We have CPP, we have EI, and we have the Canada employment amount. Total credits is $2,502.37. Going down a little further, the amount of federal tax he has to pay is only $728.18. I'm going to put that in step 6, and then we need to do provincial. Family tax benefit comes from net income. So family tax benefit, because it's based on net income, 9%. Karina, where do we indicate the CPP overpayment? I'll show you that when we get to the last part of the return, because we're going to do refundable credits at the end. But that's a good thing to remember. So if you had a CPP overpayment, you use the allowable amount for the credit and the enhanced portion, the deduction and the credit, and you put the refundable portion at the end of the return. Okay, so Manitoba Family Tax Benefit, if he hadn't had the workers' comp, he would be getting a Manitoba Family Tax Benefit. But he had the workers' comp, and it's based on net income, and so he doesn't get the family tax benefit, but we had to calculate it to be sure. Provincially, we're going to take the taxable income. This is one of those spots where if you're not careful, you're going to mix up when you use net income and when you use taxable income. So read the form very, very carefully. We need to practice the Manitoba ones. The Manitoba forms are quite complicated. So keep doing them by hand. It's the best way to learn them. All right, so he's in the lowest tax bracket in Manitoba. He gets the personal credit in Manitoba. He gets CPP and EI, and that's it. So total Manitoba credits, 1247.77. Take that off of his Manitoba tax owing, and you're going to see that even with a very low taxable income and the RSP deduction, he's paying $1,078.23 in Manitoba tax. I'm going to take that number, put it at the end of the return. Total tax that he needed to pay this year, $1,806.41. Total that he did pay, $5,326, which we expected. He put a whole bunch of money into an RSP and got a really big deduction compared to how much income he had that's taxable. We're expecting to see a big refund, and we're going to see one. And there, for you, Karina, is the CPP overpayment. So remember, the refundable portion of anything comes at the end. So we're going to, first of all, give him a refund because he paid more tax than he needed. And then second of all, we're going to give him a bit more refund because he also overpaid on his CPP. Add those together, we get 5421.4. Total refund this year, $3,614.99. Okay. Let me just see. If I have for you a calculation for next year's RSP. So for next year's RSP, if you wanted to do the calculation, we look at employment income, we subtract union dues, which gives us $27,157 times 18% is $4,888. So his RSP room next year will grow by another $4,888. How much room he's actually going to have? Well, the room he has now, minus the room he's using now, plus the eligible RSP room that we're calculating for next year, comes to $7,888 next year. So if he wins the lottery again, well, first of all, he should put it in a TFSA and not here. But if he doesn't take our advice and he puts it into an RSP, he can't go over that number. Best thing to do for your clients is tell them to read their notice of assessment to find their number. So they're going to get that notice of assessment in about 10 to 15 days after we file the return. And that's the number that they're going to take when they decide what to put into RSPs for next year. All right, now I did tell you that I was going to show you the difference if I don't claim the RSP this year. So keep in your mind roughly $3,600. Oh, Karina asked, is notice assessment available on my account? Yes. So if he has access to my account, he will be able to get his notice assessment there. If he doesn't have access to my account, and he's one of our clients, we will have access to represent a client. So he'll have access two different ways. And if he hasn't signed up for online mail, they're going to mail him a copy as well. So there are lots of options to get your notice of assessment. All right, let's take this refund, $3,614, let's make it smaller and see what the difference is if we change the RSP amount. So I'm going to do it in my program. I'm not going to show you how to do this formally because I will be teaching it to you later on in the software, but let's choose not to deduct any of the RSP. Now, if I do that, it's going to change my Schedule 7. So on my Schedule 7, I'm still going to show the contributions because he still put the money in, and I want him to have undeducted contributions that he can claim next year. So I want those to show up. So I'm going to put the total contributions in the same place. And then I'm going to put the limit in, and I'm going to determine how much I could claim, which is still $5,500. How much I'm actually going to claim is 0. So we'll put 0 on line 18, 0 on line 20, and then his unused contributions for a future year are $5,500. Is that going to change how much RSP room he has next year? Is there going to be any different between 2020, what we did before when we were claiming the deduction, and now? No, because he still used the room. It's just he didn't get the deduction yet. So it's in there, the room is full, he's filled it up, but he hasn't claimed the deduction, he's saving the deduction for the future. And then next year when he earns that more income, we can claim the amount then, claim the deduction then. Okay, now if I do this, it's going to change everything on the return. So if I do, you're going to notice there's no deduction on net income, which means his net income is higher by $5,500. His taxable income is higher by $5,500. Everything is higher. So what happens to the refund? It was $3,600 roughly. Now it's almost $2,200. So he's definitely going to get less money this year. The reason we will do this, though, is he'll get more next year. So let's talk about the difference in actual dollars, because that's helpful for our clients. He looks at it and goes, well, it seems bad to not get the money. How much more am I going to get? So if he claims the $5,500 this year, what is the value, just the federal, let's not make it complicated, what is the federal value of that $5,500 this year? Remember, he's in the lowest tax bracket? $5,500 deduction when you're in the lowest tax bracket is worth how much in real world dollars? $825, 15%. Good. If he's up a tax bracket, if he's in the 20.5 bracket, now how much is that deduction worth to him? Excellent. Thank you, Marisa. Thank you, Bo. $1,127.50. So the benefit of waiting is $302. You can do nothing for 1 year and get $302 if that's what his income is going to be. That might be an option your client will go for. He might say, yeah, I'd rather have $302 extra dollars next year. If he doesn't need, he's still getting a big refund. $2,100 refund is very nice. I'll tell you from a psychological standpoint, if this was me and I was doing this for my clients, I would have the discussion about saving that RSP before I ever got to the refund number. Because let me tell you, when you show someone $3,600, that number gets stuck in their head, and that's the thing that they need this year. They feel like if they don't get that, you're taking money away from them. On the other hand, if you talk about, we could save it this year, you'll get this much more. If I don't put it on this year, you're still going to get a refund, but it won't be as high. But this is what's going to happen. He'll make the decision, and then you'll calculate the return, and you'll tell him he's getting a refund of $2,100, and he'll be happy. So be careful about showing people final balances and then changing what you do. Once they see refund and they get a number, that's the number they're going to remember forever. But the important thing is give him the option. He has the choice. He can make that decision. Does he want an extra $825 this year? Or does he want an extra $1,127 next year? And then let your client decide. All right. And in this case, he has decided that he wants it this year. So I'm going to take the limit out. We're going to go back and give him all his money right now because he'd rather spend it now. And our refund is $3,614.99. Are there any questions about this case? Okay, I'm not seeing any right off the top, so if you do think of one, let me know on the break. We're going to move ahead. We're going to do our self-test now. So if you can, I'd like everyone to go to their books and find self-test number 3. And we're going to talk about self-test number 3 together. Okay, so self-test number 3, and we're going to do some polls. So while you get that, I have to get your poll set up. I don't know why, but this is the one thing that just never quite happens on time. So it's going to take me a moment. While I'm there, you can take a look at the first one. And we're in self-test number 3. Okay, so let's run the first poll and see how everyone did. We have Stanley. He received 400 in actual dividends that issued eligible ones. He received $15 interest from the CRA, $100 interest from the savings account. He paid $70 interest on a loan to purchase the Canadian Corporation shares and $130 for subscription to an investment newsletter. They're asking for the dollar amount of interest income, and let's see what you think it is. Okay, 10 seconds left. Noticing not everyone is answering this. You should have these done already, but if you don't, let's get an answer locked in, and let's see how we did. Pretty well. So overall, 115. Remember, you need to identify just what is interest, not what is not interest. And we're talking about income. So don't mix up the income and the expense. Income goes on to the return and adds to how much tax you have to pay. And carrying charges or interest expense is a deduction and takes away from your tax. So we're talking about income. We're talking about things that add money onto the return. In this case, there's interest from the CRA and $100 interest from the savings account, and the answer is 117. Good. I like in these questions to take a pen and cross out everything that isn't interest income and then see what I have left. That's how I do these ones. So you should have picked D. The correct answer is D, $115. All right, let's try number 2. Gary completed his tax return for the year. Then he discovered a T5007 for social assistance that he forgot about when he prepared his return. He's now going to recalculate his return. And let's see if you know which of the following amounts will be the same after we do the adjustment. So we've got total income, net income, or taxable income. Ignore the highlighting. That's for something else. That's to remind me that I want to talk about this specific thing. So if you're going to put social assistance on the return, it will go on the return and it will come off. Where does it go on? Where does it come off? Okay, 30 seconds. If you haven't yet started your poll, see if you can put an answer. Okay, half of you have participated, half of you have not. I would like to see a little more participation on this if possible. Best way to learn these is by doing it. If you get the answer wrong, then you will remember that you got it wrong, and then you remember why you got it wrong. And then you'll get it right on the exam when we get to the theory exam. All right, let's see how we did on this one. So we got a little bit of a mix. Some people said total income, some said net income, some said taxable. Think about what happens when you put a T5007. It adds to total income because it's going to make it higher. That number will change. Net income, it's still there. So if you added it to total income, you've also had to add it to net income. So that number will be higher. The one number that won't be higher is taxable income because it comes off after we calculate net income. And one thing to remember is if you're adding income on a return, it's pretty much always going to add and change total and net income. because the type of deductions that you can both put in and take out always come off after net income on the return. So generally speaking, if you're putting it in and you're taking it out, the only number that will stay the same is taxable income. Now, from a Manitoba perspective, what would happen if Gary had done his return without social assistance and had a refundable provincial credit? So every other province, nothing would change at the end of the return. But what would happen for Gary if he had claimed a refundable credit provincially? If he filled out an MB 479 and they gave him a personal amount, but he had social assistance during the year, what problem do we have for our client now? Anyone who remembers? You do not get to claim all of your personal amount if you're in Manitoba and you had social assistance. So he will have to pay some money back if he was in Manitoba and he had that personal credit. So that is going to be something you have to think about, because everyone else across the country can tell your client, we're going to do the adjustment, but don't worry, it's not going to change the refund. In Manitoba, it might change the refund, because he will have a box 14 on his TFAB 007, and it will probably be a percentage, or it will be all of it was already paid to him in social assistance. In this case, it sounds like it'll be a percentage. He's not going to get his full refundable provincial credit. So that's something you have to think about. Okay, let's try the next one. Adam has a taxable income of $70,000. How much would he save in federal income tax by making a $4,000 RSP contribution and deducting on his tax return? We just practiced this in Darren's case to decide what the value this year and the value next year is. It's the same idea. So you need to know his tax bracket, and let's see if you got the right answer. The options are 600, 820, 1,040, or 1160. Okay, 30 seconds left. Still have about half the class. 20 seconds left to get an answer locked in. If you think you have the right answer, hit the submit button for me. Okay, let's see how we did. Overall, very, very well. The way to do this question, if you're not clear, identify his tax bracket first. Which column is he in 70,000? In this case, he's not in the lowest tax bracket. He's in the next tax bracket. So you know the deduction is going to come off the top portion of his income. So it's going to save money at the tax bracket. So 20.5% times 4,000, he will save, in this case, $820. All right, question 4. Oh, that's not question 4. Hang on, I have to find it. There we go. In which tax year does the taxpayer need to claim a principal residence exemption? So the year the home was purchased, the year it was owned, the year it was sold, or never. Okay, let's try this one. This should be an easy one. So when do you report your home, your personal home, on your tax return? Okay, and we got more participation on this one, so that's good. It means I have at least given some of you an idea of what to do with personal homes, principal residences. Just a few people left. Let's see how we did on this one. Okay, almost everyone got that one right, which is correct. You don't have to report it every single year. You don't have to report it when you buy it. You have to report it when you sell it. You always have to report the sale of a capital asset on a tax return. If you want it to be exempt from tax, you need to ask for it to be exempt from tax when you sell it. So that's how I remember this one. What happens if you don't claim the principal residence exemption? What happens if you do not report it on your tax return? What is the consequence to the client? Brittany, it becomes taxable. So if you don't report it, the government can say you didn't ask for a principal residence exemption, you don't get one. If it's a very large gain, it's a very expensive mistake. And we're going to talk about penalties more in our last chapter. You can, after the fact, tell the government, oops, I missed this, please let me do it late. But if you do it late, they can charge you a penalty for being late of up to $8,000 a year. So even if they let you make the capital gains exempt, which would generally be good, especially if it's a home you've owned for a while, even if they let you make it exempt, you're almost definitely still looking at a very expensive penalty for your client. Karina, can the CRA add it to the return? If the CRA suspects that you sold something, if they catch you, then they can add, based on the information they find, to your return. More likely, they're going to do it another way, which is to say they're going to ask you for the information and then add it that way. But if you're not cooperating, they can investigate. And Helene, how will they know if you sold your home? There's a number of different ways, depending on how you get into the queue. So you might get a random audit. So they may just pick your name out of a hat and say, we're auditing you this year. They look into everything, ask you a bunch of questions, and you shouldn't lie in an audit because lying to the government is a bad idea. And they can poke into things at that time. They'll know that your address has changed. So if you lived in one place and then you lived in a different place, you're going to change your address with the CRA. So they'll be aware that something has changed. And again, that may trigger them looking into it to see if you purchased or you didn't purchase it. They might be auditing someone else. And while they're auditing someone else, they may just kind of look around. So maybe your real estate agent will get audited. And your real estate agent will have to report how many commissions they made and which homes they made commissions on. And then they match that up with the address that you have with, or you had that you now have a different one. So there's lots of different ways they could find out. I think the thing to remember is in this day and age, information is out there and people have access to it. So you should do it correctly. If you are someone who has missed this, if you've done it since 2017 and you've missed this, your best option is voluntary disclosure. We'll talk about voluntary disclosure at the end of the course. And basically it is to say, oops, I did a thing. I shouldn't have done the thing. Please don't penalize me for it. So there are options to try to ask for them to waive the penalties if they don't catch you. Once they catch you, there will be a penalty. So absolutely, Brittany, you probably can't get away with it. Better not to try, especially because it is exempt. You don't have to pay tax on it if you report it. So make sure you report it. Protect yourself, protect your clients. All right. If you want to report it, what 2 forms do you need? 2 forms to report it. Both of them have to be there. what are we adding to our tax return if we want to claim a principal residence exemption? A Schedule 3 and a T2091. You need both of them. The T2091 has to be signed, does not have to be sent to the CRA, but it has to be signed, and you're going to keep it in the file so that if they ask to see it, you can show it to them. All right, excellent. And we have one more on February 25th. And again, please do not read anything into the highlighting that I have. I just had to put a note somewhere, so I stuck it at the end. All right, on February 15th, Jody had $17,000 in her RSP. On that same day, she made a contribution of $6,500, increasing the total to $23,500. Then she was credited with some earnings, so she got some more earnings within the RSP of $1,500. So her RSP balance is $25,000. On March 15th, she went to the bank to withdraw funds to help her purchase her first home. She wants to claim the deduction in February. She wants that to be a deduction. So what is the maximum that she can withdraw from her RSP under the home buyer's plan? And you have options here, A, B, C, D, and E. This is a trickier one, but give it a try. If you haven't tried it, think about it now and see what you get. And I will talk you through it when we're done. Okay, so just a few people have answered. Let's see a few more. All right, we hit the halfway point. That's excellent. Roughly 20 seconds left. If you haven't answered it yet, give it a guess. This is a useful question for me to see how you're doing, because we're going to have one more chapter on RSPs, and if we need some review, I can work some review in. So let's see how we did. All right, most of you picked C, 18,500. If you did, you are correct. So excellent. How do we get that number? In order to claim the deduction, how many days does it have to be in her account before she can take it out? 90 days. So more than 89. So 89 or less, no deduction, 90 days deduction. What dates do we have? Well, February 15th to March 15th is not 90 days. So we have to protect the recent deduction. The way to think about this, if this helps, is it's first in, first out. So everything in there up to her recent deduction, she can take out safely. But the amount of her recent deduction has to stay in her account. After her withdrawal, it needs to still be in there. So we're going to look at her balance at the end, and that's all the contributions she's made up till now and the growth. Add all of that together, we get 25,000 because that's the balance. And then we're going to subtract what she put in that's not eligible. And the portion that's not eligible is the recent deduction, which is 6,500. So we're going to take 25,000, subtract 6,500, and you should get 18,500, and that's how you determine. Okay, so I had a note for myself. Let me see if I remember what it is. Okay, what would happen if she asked the bank to withdraw 25,000 of the home buyer plan? What would the bank do? Most likely. Okay, if she went to the bank and said, I want to take out today 25,000, the bank would say, sure. The bank would absolutely let her do it. They would not worry about the 89 90-day rule. They might not even know about it. They would look and say, you have enough, and It's less than $35,000, so sure, and they would do it. And Brittany asks, so in that case, she just wouldn't be able to do the deduction on her return? Yes. So if that happened, and she did take $25,000 out, and she didn't ask you first, in that case, you would have a problem. You would have an RSP receipt that you could not use. How would you know what date she put the money in and what date she took the money out? When she puts the money in, you're going to get an RSP receipt, and in this case, it would say January to February of 2021, or 2022, sorry, January, February 2022. Okay. Actually, no, 2021. It would be January, February 2021 from the last year. And you would see withdrawal, T4 RSP, with no date on it. So the receipt would tell you it was in the first 2 months, but the withdrawal could have been at any time in the year. If the withdrawal was before she put the money in, would have been fine. If the withdrawal was at the very end of the year, would have been fine. So the important thing that I'm pointing to and want you to think about is when you see things, you have to ask about it. This one is the trickiest one to find because she may not bring you her January, February 2021 receipt. Which tax year is connected to her January, February 2021 contribution? 2020 tax year. So it's even messier in this case because she may not bring you the receipt. She's not going to get it for this year. She already got it for last year. Okay. Brittany, is there a reason why they can't do slips for withdrawals that might be helpful? It's more work for both the government and the banks. So you are expected to know what you're doing. As a tax person, you have to ask. You have to ask all the time. If you see an RSP withdrawal, go looking for receipts around that year and the year before. If you see money going in and you see money coming out, ask about dates. That's really all I want you to do because you're not going to have this at the tip of your fingers. If you see an RSP withdrawal under a home buyer plan or lifelong learning plan, the next thing you have to do is go look for receipts for the calendar year plus this calendar year. Go see if any money went in that year, and if it did, start asking, when did the money come out, when did it go in, so that you can adjust if you need to adjust. Okay? Excellent. How would that look on the schedule? Well, if she did all of this in 2022, because that might have happened, the schedule in 2022, 2021 tax year, we would not claim the $6,500 deduction. And then next year, we would claim the withdrawal. Okay. If it happened in 2021 and she'd already claimed the deduction she shouldn't have, because she should have known the money came up, but she probably didn't tell you about it, we might have to do an adjustment for the previous year to make the deduction go away. It can be fixed, but we have to catch the mistake for our client. So the important thing for you, if you get nothing else out of this question, give your clients good advice if they came to you in advance. So she comes in, she's going to do her taxes, she's putting money in her RSPs, and she mentions, oh, I'm going to buy a house and I'm going to withdraw money under my home buyer plan to do it. Wonderful, great, here's what you need to know about that because your bank might not tell you. If it's already happened, make sure you're looking for it so you can catch it so that you can do the right thing for your client. Okay, there we go. I think that's a good place for a break. We're going to have a short break today. It's a very difficult chapter, so I want to make sure I have time to give you practice. So let's plan to come back at 9:55, and we'll jump into Chapter 9. All right, so hopefully everyone is back. Give me a check mark, let me know. If we finish early, I'll give you longer breaks later, but like I said, this is a complicated chapter, and I want to give you enough time to get through it, so we're going to jump into it together. Helene, do you have to do an adjustment if a client forgets to claim the RSP February deduction? Yes. So if they had an RSP receipt that they did not put on their return, they have to do an adjustment if they want to claim it, or if they want to report it and make it an undeducted contribution, so a carry forward. In both of those cases, you have to do an adjustment. Again, even though the CRA knows that you bought an RSP because they have a receipt, if you don't ask by putting it on a Schedule 7 in the correct year, they don't have to give you the deduction. So we do those for clients all the time because they put money in RSPs and they do their own taxes and they don't know what to do. And we find out that they've had a bunch of RSP receipts they haven't claimed in previous years, and we just do a set of adjustments for them. And we can decide year by year, do we want to claim it in that year, or do we want to just put it on the Schedule 7 and carry it forward for the future? And it's one area where we actually get some really nice refunds for clients from things that they had missed. Helene, what if they mistakenly put it in the wrong year? In that case, it's going to be a judgment call. If ultimately it works out to the same tax that it would have, I would leave it alone and not open the can of worms. But if it is going to change things, we should fix it. So maybe if they claimed it in the wrong year and they would have gotten a higher rate if they claimed it at the right time, or if it wouldn't have been allowed, we can fix it for them. So that's going to be on a case-by-case basis. But certainly if it's something that has already happened, and at the end of the day, if I do 6 adjustments to fix it and the net result is going to be exactly the same, I'd probably leave that alone and then just make sure it's correct ongoing. And put some notes in the file so that if they do get audited and we end up having to do 6 adjustments, we have the information we need. But you don't need to do the work. If it's fundamentally not going to change anything with the CRA, they don't want to waste time on it any more than you do. So judgment call here and there, but consider tax rates, tax brackets, and whether or not it does actually change what they would have owed or what they would have gotten as a refund. All right, let's try sum of dependents. So the first thing that I want to say is this is a difficult chapter because we use a lot of terminology in this chapter. Some of it is plain English that we think we understand, but when we put it on the tax return, it has its own definitions. And we tend to get those definitions mixed up with what we already know about other types of law, about other things in the world. So when I say spouse, everybody thinks they know what a spouse is. When I say common law spouse, everybody thinks they know what a common law spouse is. When I say child, you probably know who your children are. But for tax purposes, you might not actually know what the definition of child on a tax return is. We have to keep it separate from general knowledge and make it specific, first of all, to the tax return, and then second of all, to each individual credit that we're talking about. So we're going to talk about credits. Both non-refundable credits and refundable credits can be affected by dependents. Every single credit has its own set of rules. So if I say eligible dependent, I don't know what eligible dependent means unless I know which credit I'm talking about, because I can use that word in 3 different places on the tax return, and it can have a different answer each time. So I'm going to give you broad strokes first, and then as we get down into the individual rules, you need to be very organized about how you study these rules. So organized means attach the set of rules to the credit. When you're looking at the credit, those are the rules you're going to use. If you're looking at a different credit, don't mix them up. Don't start pulling things together. I will, at the end of the course, probably not right away because we're going to deal with a few more of these when we get to medical. After we finish the chapter on medical expenses, I'm going to give you a table that I do every year to summarize out most of the personal credits that are connected to dependents. So personal credits, spousal amounts, eligible dependent amounts, caregiver amounts are the other one. I'm going to organize them all into a table for you with a few helpful hints as to what rules to think about and how to keep them separate. But you're going to have to find a system that works for you for all of this. Okay? So let's start with the big term, the idea of a dependent. People can claim dependents on their tax returns. This is a concept most people understand, even if they don't know much about tax returns. The definition of a dependent by the CRA is fluid, but generally speaking, a dependent is someone who relies on you, the taxpayer, for support. The definition of support can be a little interesting. We're going to talk about that. And who the individual is might change depending on the credits. So most of the credits require the dependent to be a relative, either by blood marriage, common law partnership, or adoption. With a little asterisk when we get to child, it gets a little interesting. Okay, but not all of the credits require them to be a relative, and some of them allow some relatives and don't allow other relatives, so every credit will have its own rules. But most of the time, it has to be some type of connection between you and the person that you are supporting, other than friendship. Most of the time, in Manitoba, not all of the time, in medical expenses, you'd be learning about a credit where that's not relevant. Okay, so broad strokes here, this is where we get fuzzy. Most of the time, the dependent has to be resident in Canada, but not all of the time. And most of the credits related to dependents are limited by the dependent's net income. So if the dependent has income, it usually reduces the credit. Not always, but usually. Okay, so there's the big picture, and it's already sounding fuzzy because support is always part of it. You're not a dependent if you're not providing them support, but the relationship, we have a whole range of relationships that will be allowed, but it may be important. Residency in Canada might be important, and the net income of the dependent might be important. Often is important, but not always. Okay, let's drill into this a little bit more. When I say support, what do I mean? Well, the Income Tax Act doesn't define support. It just says support. In Canada, we have case law, so lots of people would put a dependent on, and the CRA would say, you're not supporting them, and they would say, yes, I am, and they would go to court. So lots and lots of legal cases have determined kind of what support means. Most of the time, it means the provisions for the necessities of life. The necessities of life are food, lodging, clothing, and to some extent medical care. And it's almost always, there's one exception on the return for this, but it's almost always financial support. So can anyone give me some examples of support that you might give to a dependent? This could be a child or it could be an adult who is dependent on you in some way. What types of support would not be included? What are things that you would do when you're looking after someone who needs assistance, who's a relative of yours, that would not fall into this definition of support? So money usually is support, but it depends what it's being used for. If that person is able to pay for their rent and their clothing and their food, and you're just giving them money to be nice, probably not. Supporting people with education is one. Transportation is a big one. So Brittany, you've got the right idea here. How many times have we driven our kids to school and to soccer practices? Or have we driven our parents to medical appointments as they're getting older? And maybe, help them with getting to not just doctor's appointments, but other things as well. Maybe it's emotional support. Maybe you have a parent who needs some recreational time and some visiting and to be brought to see friends. Maybe it's things like caring for them physically, but not financially. So maybe they don't have a carer that you're paying for to come into the home, but you're doing wound dressing, or you're helping them to get dressed, or you're helping them to eat. Okay? Financial support is most of what we're talking about. And it is support for food, lodging, you're helping to pay their rent. Clothing, you're buying clothes for them. And medical care, financial support for medical care. You are paying for their doctor's appointments or for their out-of-pocket medical costs. Okay. So that's what the CRA and the courts have determined is meant by support in most cases. Okay. It doesn't have to be 100%. They can have some income, but if they have enough income to cover their food, lodging, clothing, and medical care by themselves, then they are not dependent on you. And so some support at some point during the year that they required. If that is the test you meet, we can talk about dependence on the tax return. And again, we most often assume that dependents are younger than us. Most people agree that you are providing food, lodging, clothing, and medical care for your children before they turn 18. But it's possible to have a dependent who is over the age of 18. You might have a child who is an adult but has a disability and they're not able to provide their own income to a degree where they can be completely independent. So you might need to assist a child who is an adult with food, lodging, clothing, medical care. You will very often find, if you haven't already, that as your parents and your grandparents get older, they may need some financial assistance in these areas as well, in which case you may have a dependent who is older than you. So broad strokes, dependent is a person that you are providing, and I'm going to say financial support. Again, there will be one exception in Manitoba. We'll talk about it in medical. But every other thing on the tax return is financial support for the necessities of life, which has been defined as food, lodging, clothing, and medical care. Okay? So that gives us the idea of who might be a dependent. Now we want to talk about relationships. Helene, do they have to live with you? No. Sometimes, yes, depending on the credit. Sometimes the credit will say they must live with you. Other times the credit will say no. Maybe you're not providing lodging, but you're providing food, clothing, and medical care. Maybe they live somewhere else, but you're contributing to the cost of them living somewhere else. So they might be in a long-term care home. It might be a disabled adult relative of yours, and you are helping them with their rent. So you are helping them with lodging, but not necessarily putting a roof over their head. But again, what you're going to find is it depends on the credit. So the credit might change the rules for you. We're going to start with who might be a dependent, and the way that I approach a tax return is I identify everyone that I'm supporting or my taxpayer is supporting. And then I look at the tax return and I look at all the different places where a dependent credit might be claimed. And then I look at the rules for each of those lines individually. So I'll start with the big ones. Do they have an eligible dependent? That's always a big credit. Do I have a spousal credit? That's always a big credit. And then I drill my way down into smaller and smaller credits until I see if there's anything left. Okay. So we've talked about support in broad strokes. I want to talk about relationships in broad strokes. So remember how I said you think you know who your children are? It's a little different for tax purposes. So tax purposes includes a natural, that means one that you've given birth to, or your spouse has given birth to, or adoptive child, so someone you have legally adopted. But it goes beyond that. It also includes any dependent who was under your custody and control in law or in fact. It doesn't have to be a legal custody situation. It can just be a reality custody situation. Before they turned 19, and at the time, they were wholly dependent on you for support. Wholly dependent means you paid for all of their necessities of life. Okay? So I'm going to give you an example because I think this is easier to understand if you can think about real-world situations. So I had a client who had a sister who was going through some difficult times, and that sister had 2 daughters. The sister did not give custody to her sibling. She just said, I can't care for my children right now. Can they stay with you? And so my taxpayer, my client, took her nieces in and cared for them for 3 years. So in that period of time, she provided them with a home, she paid for their food, she took them to school, she took them to doctor's appointments. There was nothing in writing, there was no legal change in guardianship, but she was in charge in fact. She was in custody and control in fact, not in law, but in fact. And as a result, she was able to claim her nieces as dependents on her tax return. Okay, so the relationship doesn't have to be by blood. In this case, it was, but it didn't have to be. And all they have to be is a minor, so someone before they turn 19, in your custody and control, and they are your child. And Helene, grandchildren is an excellent example. This happens to grandparents who look after their grandchildren. May not be a legal arrangement, may not even be a blood relation, or they may be your step-grandchildren who are now living with you. So lots and lots of different scenarios can happen. Once you are someone's child, they are your parent, that relationship continues for tax purposes. So when someone becomes your child for tax purposes, they can continue to be your child for tax purposes. When someone becomes a parent of a minor, under the definition on taxes for that, they continue to be a parent. So it's a little bit fuzzier than we think it is. And we're going to do a little practice here and see what custody and control means. So when I say care and control, what kinds of decisions are you responsible for? What kinds of financial support are you providing? What are the things that would establish this if you don't have a custody order or a legal definition? What are the sorts of things you do for children that indicates you have custody and control? You might make medical decisions for them. You might bring them to the doctor. You might have educational decisions. So you are in charge of which school they're going to, whether they're doing their homework. Discipline, you might be deciding when they get in trouble and what the rules are for your kids. Big ones are financial. Remember, support is usually tied in some way to financial. So you're also providing them with a roof and with food and with clothing so they can go to school, all of those things. This is the sort of thing we're going to talk about. Okay, and we're going to do a little activity here, and I want you to tell me, for each scenario, does the dependent qualify as a child for tax purposes? So we have Carol. Carol is 17. Her birth parents died last year. Carol moved in with her cousin David. Carol is wholly dependent on David for support. Is Carol considered David's child? If you think yes, give me a green check mark. If you think no, give me a red X. They are cousins. Okay, I've got a few people. Let's get everyone participating in this one. Okay, I see lots of green check marks, and I agree with you. So in this case, absolutely, Carol will be considered David's child. For this tax return and for ongoing tax returns, there may be opportunities for David to claim Carol as a dependent. Anywhere where it says child, David is now Carol's parent. Carol is now David's child. We don't have to say cousin anymore. We're going to say parent and child. Good. Let's try the next one. Okay. Adam is 22 and has developmental issues. Adam's birth parents died last year, and he moved in with his uncle, Bob. Bob takes care of Adam, and Adam is wholly dependent on Bob. Will Adam be considered Bob's child? Give me a green check mark if you think the answer is yes. Give me a red X if you think the answer is no. and this I expected. I see a little bit more. Karina says, should be under 19. I agree. He should be under 19. If he's not under 19, he is not a child. What is he? He's still a nephew. He is still Bob's nephew. He may be a dependent of Bob, but the determination of his dependency is going to be on the relationship of nephew and uncle, not on a child-parent relationship. And that is going to be important later on in today's class. Okay. So later on in today's class, we'll look at a scenario where nephew and uncle matters as compared to parent and child. What if Adam moved in with Bob the day before his birthday? So if he first moved in with Bob the day is his uncle the day before his 19th birthday, and now he's 22, then he is a child of Bob's because he became a child of Bob's when he moved in with him before, well, he was still a minor. He became a child of Bob's. That relationship will continue because the parent, excellent Brittany, because the parent-child relationship was established while he was a child. So the dates will matter in this case. And for those of you who are concerned that Bob can't claim Adam, Bob probably can claim Adam as a dependent for a number of credits, but he may not be able to claim as a dependent for all of them. So if we have a credit that says child and parent, then we have to factor this in when we make that determination. Is child will be anyone you had care, custody, and control of, and they were wholly dependent on you for support while they were minors. And then we start with that definition and apply it to the individual rules for each credit. So that's how that's going to work. And you're going to get to practice this. Okay? So we've talked about parents and children. I want to talk about spouses next because the first most common type of dependent we see connected to tax returns is parents and children. The second most common one we see is spouses. And again, the definition of spouse is not necessarily what you might think it to be, because it doesn't always have to be a legal contract. So if you get married to someone, you are legally married, you are their spouse. That is a legal contract, and you are a spouse. That one is easy. You're married or you're not married. Okay? Common law for tax purposes. So not common law for provincial law or common law if you're in Quebec. Might be different in different provinces, but common law for tax purposes means someone you have lived with in a conjugal relationship, that means an intimate relationship, for a minimum of 12 consecutive months, no break up, get back together, break up, get back together. You have to live with them for 12 months, or be in that relationship and be a parent of their child. Now, parent of their child can be easy. If it's a biological child, it's a biological child. But remember, you might be the parent of a child who has no blood relationship to you and you have not adopted them. If you have care, custody, and control and they're minors, they are your child. And as soon as you have two adults in a relationship together with a child in the house who is their child, you are common law from that moment on. Okay? Taxpayers do not know this. So we need to make sure that they know this because we have to file the tax returns accurately. Remember that having a spouse can affect any number of things on the tax return, including your benefits. GST benefits are based on your spouse, and spouse means married legal spouse and common law spouse. Net income becomes a factor for GST, for Canada Child Benefit, for all of those things. So if you have someone who has children and they're moving in with a partner, you want to make sure they understand the tax consequences of doing that. All right, so someone you're legally married to or someone you have a common law relationship with, If you break up, but you get back together within 90 days, you are not separated, and it continues as part of the 12 continuous months. So let's say, just to make this easy, you move in with your partner in January, and you move out in February, and you move back in March, and you move out in July, and you move back in August, and you're still together in December. That counts as 12 continuous months. On the other hand, if you move in January and you move out in February and you move back in again in October, not 12 continuous months. So that 90 days becomes very important. Does that make sense? I know it's a little fuzzy. The idea is continuous without a significant interruption. And the government has decided significant interruption is 90 days. Okay? Being moved in together is important for common law. Being moved in together does not matter if you're married. So I have clients, they married each other legally, but they kept two separate homes. Sometimes they will sleep over at one person's house or the other person's house, but they have not moved in together, and they keep everything separate. But they are married, so they file as married. Okay? Common law, you have to move in at some point. You have to move in together at some point. So that's different. And if you move out, but not because of a breakdown of the relationship, it doesn't count as a separation. So I'm going to give you an example for what I mean. So this is where it's like, oh, this is very simple. I understand what it means. And then I give you a real world scenario and you go, huh. And I will tell you, we had to figure this one out kind of collectively as a group. But I had a client where he moved in with his girlfriend, and then he went to prison for 9 months. And when he got out of prison, he was back with his girlfriend because they did not break up while he was in prison. They were still together, but he wasn't physically living in her house because he wasn't allowed to physically live anywhere other than in prison. Would that constitute a separation that would change their status? So if he had not gone to prison, he moved in with her. At the end of the year, he was still living with her. They were together for a full year of their common law. Does the fact that he was physically in prison for 9 months change? Does that count as a separation? No. And like I said, that's a tricky one. A separation means a breakdown of the relationship plus moving out. If the relationship didn't break down and circumstances affected you, maybe it wasn't prison, maybe he was in hospital for 6 months, maybe he was in a terrible accident, but their relationship survived and he was staying with this person. In that case, not going to be a separation, so they will continue to count the days from the original move-in date towards determining their common law relationship. So most of the time this is simple. When we get into common law, it can get messy. And Helene, if he was stationed by an employer in some other city and it's not a breakdown of the relationship, as long as it's clear that the intention is not a breakdown of the relationship, then that's what we need to do. Okay, so if the relationship is still solid and you moved in, then technically still common law partner. Now that gets trickier, obviously, if you didn't really move in, if you just kind of dropped some stuff off and then went somewhere else. So like I say, if this gets fuzzy, sometimes it's not easy, but if you intended to move in, you did move in, you're in a relationship together, and then something happens that makes you go somewhere else, but you haven't ended the relationship, the common law clock is still ticking down. All right, and Nancy has an excellent point that I'd like to point out. 12 months of common law doesn't have to be January to December. It just means 12 months. So this can be a fun one, because what if your clients moved in together in March, and now they're coming in February to file their tax return? They have not been together yet. So they will be filing as single for 2021, but next year, what will they be filing as? Common law. Excellent. Going to give you a similar one What if they moved in together in February? Now it's March of the next year. How will they file for 2021? In 2021, had they been together for 12 months? No. So they're still single for 2021. Yep, this is why we practice. This is how you learn. Still single for 2021, but next year, they will be filing as common law next year. So we're going to talk about that. We're going to talk about what forms you need to prove it. Brittany had a really good question, which is how does the government know? And are they going to check your text? The main thing is most people don't want to file as married or common law because usually putting two incomes together means you get less benefits than when you have one. Most people, given a choice, would pick single. So if you're in a relationship, and you should be in a relationship together, then you should file correctly. Will they necessarily catch you if you have two different addresses? No, but I'm going to give you another example from real life. I had my very first year doing taxes, had a client come in with a, I'm going to put this in air quotes, with a friend and a newborn baby. And the friend, so I asked the question I always do, am I filing one tax return or two? Because that's my discreet way of asking if they're together. And they said, oh, we're just filing one, she's single. And I said, okay, great. And she said, my friend is going to come and help me because like moral support, fine, not a problem. If you're okay with that, I'm okay with that. Where are you living? Well, she was living in his house and it is his baby. So now I have some questions because she's there with a newborn baby and the father of her newborn baby living in his house. And he says, oh, no, but we don't live together. I sleep on my brother's couch. Uh-huh. Okay. So what proof do you have that you are not living at the house that you own that she's not paying rent for, but you're paying the mortgage on? And of course, all of his mail goes to his house and he pays the utilities for his house. And I say, do you pay rent to your brother? Will he issue a receipt for that? No, I just help out a little bit. Okay. And it turns into a conversation because the reality is, and I don't like to tell my clients that they're lying, but the reality is they're in a relationship together. They have a baby. They are together. What I say in that situation is, well, the problem that I have is the CRA is going to notice that you're both at the same address and you have a baby together. And you do not have anything to convince the CRA otherwise. And it's not a question of me believing you or me not believing you. It's a question of what can I prove to the CRA. I cannot prove to the CRA that you are not together. If they look at this, and they will, because he had a lot of income and she had no income, and she wanted to get Canada Child Benefits based on no income and GST based on no income and all of those things, believe me, they audit those. They will look at your scenario and they will say, you are common law, so I have to file you as common law unless you can provide better evidence that I could convince the CRA otherwise. So we filed them as common law, which I am very confident was the right decision. And again, the question of how will the CRA know? Well, her address is the house she's living in. His address is the house he supposedly isn't living in but is paying for, where his partner and baby are living. So again, how will they know? That seems fairly evident. And of course, if there's a breakdown of the relationship and he can prove a breakdown of the relationship, then they can be separated, but for that tax year, common law. All right, let's do a little activity here. Okay. We've got Harry and Sophia. They moved in together on June 4th, 2021. Neither have any children. For 2021, how will you file? Single, common law, what definition will you have for them for the 2021 tax year? Okay, lots of people are saying single. I agree with you. What date? Excellent, Brittany. What date will they become common law? Assuming they stay together. June 4th, 2022. Very nice. On June 4th, 2022, what form do they need to file with the government to tell the government that their marital status has changed? Someone who has read the book, because I haven't mentioned it yet. Excellent. It is an RC65. So if you have not seen this, you should take a look at one. And I will pull one up for you. How to find this form if it's not in your fillable package, you can Google CRA change of marital status or CRA RC65, or go to the Canada CRA website and type in RC65 or type in marital status change. All of those things. Okay, I print these for my clients and I give them to them, and I tell my clients in this exact scenario, we've got Harry and we've got Sophia, and they're coming together because they're very excited. They're doing their taxes. They've changed their address. They've moved in together. Congratulations. That's wonderful. Find out about kids, no kids. Okay. Here you go. I print two, one for each of them. I say, put this in an envelope. Put a date on the outside of the envelope. On your anniversary moving in together, you're going to get yourselves a bottle of champagne if you want a bottle of champagne, a bottle of sparkling juice if you want a bottle of sparkling juice. You're going to open the envelope, fill it out, sign it, send it to the CRA, and then you're going to toast 1 year of being together. Has to happen after the anniversary, can't happen before. After the anniversary, have a celebration, and then file this with the government. All right, it sounds silly, but people remember that, and then they do it. So you have to fill in the information. Each of them will fill this in with the address and the date they moved. And then you're going to say living common law, the date it began, that's the date. The date it began is June 4th, 2022 is the date they became common law. That's the date you put there. And then your partner's information and a signature from each of them. And then you send it in. Where do you send it? It tells you at the bottom of the form where to send it. And that's what you're going to do. How long do they have? How long do Harry and Sophia have to send this form to the government? So the common law date happens on June 4th, 2022. What is the deadline for sending this to the government? So Karina, it's not 90 days. 90 days is having to do with separation. What does the form say? It says you must tell us by the end of the month following the month in which your status changed. So if their status changed in June, the following month is July. They have until the end of July. So they have until July 31st, 2022, July 21st, or July 31st, 2022, to send this to the government. What are the potential consequences of not sending this to the government? So 2021, they're going to file a single. Halfway through the year, they're going to become common law. When they become common law, all of their family credits, family benefits, will now be based on different income numbers. So if they don't send it, because let me tell you, most people don't, if they don't send it, what will happen when they come and file their next tax return? 2021, they're going to file a single. 2022, they're going to file as common law. The government is going to say, what date did you become common law? What will happen if one of them was collecting GST benefits because they had low income and the other person wasn't because they had high income? What will they have to do? They have to pay it back. So it's very important that you do this. I had clients, they're actually the same clients, who married each other but did not move in together. I knew they were getting married because they told me that they were getting married. And in that case, I said, here are your forms. Make sure you file them, because one of them had a high income and did not get benefits. And in this case, it was not just federal benefits, but provincial benefits as well. The other one did. And I said, if you don't send this in, they're going to keep sending you your benefits, and then you're going to file your taxes next year, and they're going to ask you to pay it back, and they're going to take it right off your refund, because they can do that. And the client did not send it in, and then they did their refund, and then they didn't get as much money as they thought they were going to get, because they had to pay a bunch of benefits back. And they said, why didn't I get what you said? And I said, did they deduct this amount? And they said, yes. And I said, do you remember we had the conversation? They said, oh, yeah, I didn't send it in. Right. So here we go. That is what happened. So it is very important, if you know their marital status is going to change, update them. And Brittany, excellent question. If you move in with a female best friend for more than a year, no one's going to make you file as common law. But if you move in with a male best friend, they won't believe you're just friends. Is it unfair? 100%. 100% unfair. How can they prove? Well, if they suspect it, they can look into it. So they can audit, and when they audit, they will ask not just you, but people around you, and they will poke into your private life. They can do that. But unfortunately, I would say the CRA has not caught up with the realities that some people have different sexual relationships with different genders. There's a whole spectrum. The assumption tends to be towards heterosexual couples. Children definitely change that. And the question is, if you are a lesbian and you live in common law with your girlfriend, can you get away with never filing it? You might actually get away with it. It is, again, changing slowly, but yes, you might. It can become a problem. So we had clients who had done that. They were common law. They were in a same-sex relationship. They never filed as common law. They wanted to file as single. They never told anyone that they were in this relationship. When one of them died, the other person applied for a CPP survivor benefit based on the fact that they were common law. But the problem was they didn't want to be common law for all those years, and they had not filed as common law for all those years. So you can't only be common law when you want to be and not be common law when you don't. So the reality for my clients is, be honest. Don't try and get away with things you shouldn't get away with. And sometimes there are benefits to filing as common law. So again, in the scenario where one of the clients is a very low income and the person is a very high income, the low income person may lose some benefits, but the high income person may claim some deductions. They may get some credits. They may get a spousal amount that might be similar or equivalent. They may be able to claim medical expenses that they couldn't have claimed. They may be able to claim donations that they couldn't have claimed. So file your returns accurately. Convince your clients to file your returns accurately. I think we will see things catch up in the next, I'm going to say 20 years, because I'm not an optimist. We're going to start to see that people are more aware. But you are absolutely right. Right now, there is an intrinsic bias in the system towards different sex couples. Helene, back to GST payback. You thought GST was based on last year's returns. GST ongoing, and you have to change. So it's based on last year's returns income, but it's based on your current family net income. So it's based on your marital status that is current, but the income from last year. So that's the fun one. So it's family net income from the moment you have a family, but last year's income. Yep. And that clawback we see all the time, because most of the people do not update their marital status when they get together. When do people start asking you to file a change in marital status? Who are the people who are very excitedly wanting to send this information to the CRA? In most circumstances, what do you think? When does someone come to me and say, how do I tell the government that my marital status has changed? I want to do it right now. When they separate. When they separate, when they divorce, they are very excited to tell everyone that they are not together. When they get together, most of the time they just don't know that they need to, but sometimes you will get clients who don't want to. Can I just say I'm single? If a client says to you, can I just say I'm single? What do you tell them? Just say no. If you're not single, you're not single. For tax purposes, you're not single. You can't file that way. You can get in a lot of trouble and it can be very expensive. Don't do it. All right. And again, how will they find out? Well, if you're both living at the same address and 3 years later there's a child in the house, they'll probably notice. So things will become evident on the tax return. May not happen right away, but it will happen eventually. All right, let's try some more. So let's see. We've got Marcia. Marcia gave birth on August 18th, 2021. Ralph is the father. They moved in together in September 24, 2021. What will their marital status be at the end of the year? So what will they file for 2021? Common law. Excellent. What is the date that they're going to put on their RC-65 to say that they became common law? What is the date that their marital status changed? September 24th. Excellent. When did they have to file their notice by? When did they have to file the RC-65 by? October 31st. The end of the next month. Good. Let's do a bunch more. Alan married Amanda on September 15th. They did not live together before getting married. After their honeymoon, got married, went on a honeymoon trip. Alan was posted overseas for 6 months. So they were not living together at the end of the year. What will their marital status be for 2021? Married. Excellent. What date will they put on their RC-65? September 15th. Legal marriage is legal marriage. Clara has a child from a previous relationship. Clara's boyfriend, Felix, moved in on November 12th. Felix does not help with any of the bills and does not assume parental responsibilities. We're not going to give Clara life advice. We're going to give her tax advice. What will Clara's tax marital status be at the end of the year? Single. When will it change? Assuming they stay together? November 12th, 2022, or when he starts providing custody and control, care, custody and control of the child. So at the latest, November 12th, 2022. Okay. I will say you have to be careful with this one. The younger the child is, the less likely it is that the government will agree that he is not doing anything to support the child. He might not be, and they may have proof of that. But it is a lot harder to live with a baby and not assume any parental responsibilities than it is to live with a teenager and not assume any parental responsibilities. If you're living with a baby and you leave the baby crying and you don't feed it, then you're still not going to have care, custody, and control. But yes, at that point, Clara would have to think about what she's doing. So Helene, yes, if Clara is single, Felix is, well, he might be single. He might be married to someone else. So that could be a thing. Then he'd probably be filing to separate it, I assume. So that's a fun one. But remember that the younger the child is, the more likely it is that you're going to be doing some parental responsibilities. You're probably going to be feeding the kids. You're probably going to be dropping them off at school and picking them up and taking them to the doctor. So younger and younger children can be difficult. So a child changes marital status if he has established any type of parent-child relationship. So if there's care, custody, and control, child will change marital status. If there isn't, it won't. But again, with a little star, What is it going to look like to the CRA looking from the outside at the relationship? All right, here we go, another one. Ada and Kevin have an on-again, off-again relationship. This happens for years. In 2018, they had a child together. He didn't live with Ada in 2020, but he moved back in with her on December 3rd, 2021. He doesn't pay bills and he doesn't assume parental responsibilities, but it is biologically his child and he is living with the mother of that child. What will their marital status be for the whole 2021 tax year? Because he moved in on December 3rd, 2021. Common law, excellent. Because of the blood relationship, even if he's a deadbeat dad, he's living with his child and in a relationship. So now, common law, it's his from December 3rd. And yes, Ada and Clara should get together and have a discussion about the men that they are with. I will say deadbeat dads is the term we use very frequently. It can go the other direction, but in this case, we've picked two examples. Okay, a couple more. Benny and Ramon moved in together on December 31st, 2020. They have no children. What will their marital status be for 2021? 2021, they have now been together for 365 days. Common law. The date of change is December 31st, 2021. That is within the tax year, so they are common law for 2021, and they should file an RC65. I will say this scenario doesn't come up very often because it's a real pain trying to move on New Year's Eve. Most of the time, people will move a little bit before, a little bit after. Not a lot of people are giving up their New Year's Eve to move in together, but theoretically it could happen. And I will say weddings do happen on New Year's Eve, but moving is just a pain. Oh, Marisa, so your anniversary is December 31st. Does that mean you get to celebrate with friends every year or personal? I'm a stay-at-home on New Year's Eve, but that's because my husband's a doctor, so he's usually on call. So I have Netflix and apple cider and things like that. And I don't have to stay awake if I don't want to. All right, couple more. Valerie and Susie moved in together on June 11th, 2021. They adopted a child together on July 2nd, 2021. What will their marital status be at the end of the year? What is their marital status for 2021? Common law. Common law because they've adopted and they are now parents to a child and in a relationship. And the date of the change is, what is the date that their marital status changed? What do we put on the RC65? July 2nd. Excellent. So it's important to remember in real life, you can have a spouse and a, for tax purposes, common law partner at the same time. I had a client. He was my client for a couple of years. He was married with kids. And he had a girlfriend who had a kid. And in one particular year, he left his wife and kids to move in with his girlfriend and his kid. And at that moment in time, he was married, legally married, had a legal spouse, but for tax purposes, common law from the moment he moved in with his girlfriend and child. And then 4 months later, he moved back in with his wife. So now his common law girlfriend is separated. So he has a separated common law spouse and a married person and a spouse. And then the next year he came back and he was back with the girlfriend. And the year after that he came back and he was back with the wife. And that just was what happened. He just could not pick between the two and he kept changing his mind and he had to file a lot of RC65s. So life is messy, families are messy, taxes are families, taxes are about life, so they get messy too. All right, let's do the last one. Robert and Kendra rented an apartment as roommates on April 14th, 2020. They are not a couple, so they're not in an intimate relationship. They're just roommates. What is their marital status for 2021? Single. Continue to be single, ongoing. The longer they stay living together, the more likely the CRA is to ask them about their relationship. But they are single. They're not in a relationship, so they are single. Okay, good. Vicky and Ray moved in together on May 23rd, 2021. Ray is a child from a previous relationship. Vicky provides complete support and takes on parental responsibilities. What is their marital status at the end of the year? Common law. Not her biological child, but she is in a parental role. Okay? It doesn't have to be complete support. It can be partial support. But if she is taking on a parental role with the child, common law. From May 23rd. One more. Holly and Eric moved in together on February 22nd. Holly gave birth to a baby girl, Serena, on November 30th, 2021. What is their marital status for 2021? Common law. Excellent. What is the date they became common law? November 30th. And Brittany, is it Eric's baby? It's not specified. I would hope that it was based on the dates, but that is a question you may have to discreetly ask, because if he's not taking on custody and control, then no. But if they're still together and she's just had a baby and she was pregnant for the whole time, more likely he's going to act as a parent if he's going to be acting as a parent. And remember, a baby, very hard for the CRA to believe that there's a baby in your house and you are not providing any support. No financial support, you're not paying rent, you're not buying food, all of those things. So every situation that I have that looks like this ends up being common law. But it's messy. And be discreet and be kind to your clients. We are not judging their life choices out loud. We really shouldn't be judging them at all. People have whole kinds of different scenarios, but we do have to make sure that it's addressed correctly on a tax return. All right, why do we care about spouses? Let's do a few things and then we're going to take a break. We care about spouses because there are credits. So the first credit I want to talk about is the spouse or common law partner amount. The basic amount is the same as the basic personal amount. So if you're in the bottom tax brackets, it's $13,808. If you're in the top two tax brackets, it will match what your personal amount is. Okay. And you have to reduce it by your spouse or common law partner's net income. So this is important. They get a credit if you're supporting them, but the credit does not include their income. So we have to subtract their income from it. It's the net income that we're subtracting, not taxable income. Okay. To get it, you have to have a spouse. So we've already established who does and who doesn't have a spouse for tax purposes. And then we need to know their income. Where are we going to get their income from on the tax return? Where will the CRA see their income? What part of the tax return have we already recorded the net income of the spouse? Page 1. This is why we put it on page 1, so that we can use it. There is a caregiver amount. I will talk about that when we get to medical. So for now, acknowledge that it exists. We will take more time and apply it later. We do need a Schedule 5. So I want to make sure you've looked at a Schedule 5. I'm going to pull one up as well, if I can find it. Schedule 5, like the rest of the schedules, is here on the left side. Lots of things go on a Schedule 5, but the first line that comes up on a Schedule 5 is for line 30300, which is the spouse or common law apartment. They're going to ask if your marital status changed. If it did, to other than married or living common law. So if you separated or divorced, we're going to fill that in. but we'll talk about that later. We're going to deal with people getting together today, and we're going to worry about what happens when they break up on another class. Okay. Basic personal amount, whatever you had for your personal amount will be here. And Marie said, yes, widowed will also be other. Okay. We're not going to do widowed in this course. If you're widowed during the year, that requires a specialist. But we are going to deal with separated and divorced, but not today. So basic personal amount, line 30,000 of your return. Caregiver amount we'll talk about later. So line 1 plus 2 right now will always be the same. Minus their net income from their return. And in this one, you get the spousal amount based on their net income for the whole year. Again, there's a note here. We'll talk about that when we get to more complicated family situations when there's a breakup. But it's going to be net income for the whole year. So even if you were not supporting them for the whole year, then it's still going to be based on their net income for the whole year. So the year that you get together, or if you're together for the whole year, we look at the whole year's income. Okay. Take line 3 minus line 4. If there's anything left over, you put that on line 30300 of the return. And that's it. Do you remember in Chapter 7, I said there's a special rule about dividends that has to do with spousal amounts, and you're probably going to forget it. So if you don't remember that I said that, we're going to do a little test here. What is the special rule about dividend income with spouses that has to do with spouse and common law partner amounts? Who remembers? You can go back to your book if you need to. Chapter 7, not attribution rules, although that is in Chapter 7 and is important. If you have a spouse and you are the higher income spouse, Marisa not must report, but can report. You have a choice. The higher income spouse can choose to report all the dividend income if doing that would increase a spouse or common law partner amount or would create one where there wasn't one before. So now you know when there is a spouse or common law partner amount. It is when their income is very close to that basic personal amount. If we take the dividend off of the spouse, the dependent spouse, and give it to the higher income person, and it increases the number in box 5, either creates a number where there wasn't one, or it takes the number that was there and makes it higher, we have the option of transferring that dividend income and claiming it on the higher income earner, which means they have more income, which is bad, but they have a bigger spousal amount, which is good, and they get the dividend tax credit, which is good. So most of the time, it is beneficial. So now that you know how spousal amounts work, you should also go back to Chapter 7 and make sure you're confident in how dividends work. Okay, so I have tied those two pieces together. We've shown you a Schedule 5. That is the spousal amount. Okay, we're going to take a quick break here. Oh, almost perfect timing. It's 10:58. I'm going to say take a break until 11:05, and then we're going to come back. And Helene, only one spouse can claim the spousal amount. We'll talk about that after the break. So take your break, enjoy, and I'll answer that question on the other side. Okay, give me a green check mark if you're back. We're going to go through some more tricky things with a lot of examples. I'm going to give you a bunch of real-world examples to test it. And I think I'm going to have enough time to go through all the provincial ones. The provincial ones in Manitoba are tricky when it comes to dependents. So I'm going to spend a little bit of time on that. I'm going to try to get some review problems done. If we don't do the review problems today, we will catch them up. So I'm going to do my best. I'm going to talk really fast, ask lots of questions if you have questions. And let's see, we've talked about spousal amounts. The next biggest credit that we give to people, usually bigger than the spousal amount, is eligible dependent. So I want to talk about that in a little bit of detail. It is tricky. So starting broad strokes, eligible dependent, for the amount for an eligible dependent, remember every line on the tax return has its own rules. So just because something says eligible dependent, these won't necessarily be the rules that apply. These are the rules for line 30400 of the credit. It starts like the spousal amount. The base amount is the same as your personal amount, whatever that is. There is a caregiver amount, which we will talk about when we get to medical expenses, because I'm not going to talk about it now. It's too much. Let's start with just the base amount. In order to have an eligible dependent, you must be single, separated, divorced, or widowed at some point in the tax year. And at the point when you were single, separated, divorced, or widowed, you had to have the dependent with you. Okay, so there has to be a time when there was a dependent and you didn't have a spouse. If that is true, you might have an eligible dependent. We're going to talk about all the rules in more detail. Okay, if you have one, you take the basic amount, reduce it by their net income, and give them a credit on the schedule. So I'm going to look at the schedule again very briefly. That's not the schedule. Where did I put it? Oh, I hope I didn't close it. I think there we go. Okay. So we looked at the spousal amount. Now we have eligible dependent. They have the rules summarized here, which you can use. I will give you a better way because you can see there are a lot of rules for eligible dependent. So we have a nice checklist that we're going to be looking at. Once you've determined you have an eligible dependent, if you want to put it on the return, you have to fill in this line. You need the name and address of the dependent. If your marital status changed to married or common law in the year, tick the box and enter the date of change because they will factor that in. Okay. So this time, it's if you became married or common law, you need to tick the box. We'll talk about the impairment in physical or mental functions when we get to next chapter. We're going to do basic personal amount. And then line 1 plus line 2 for today is going to be the same. Then you do their net income, and that gives you the remainder. If you have a choice between a spousal amount or eligible dependent, you can only pick one. Which one is usually better? So let's say you were a single parent at the beginning of the year, you had a child, and then midway through the year, you got married, and now you have a spouse. In most cases, which one is better? Okay, Bo, Marisa, you say child. I agree. Why is the child usually better than the spouse? Because usually the child doesn't have income, and often the spouse does. There are times when the child could have income. Even if they don't need to file a tax return, they could have taxable income. Think about things like a CPP child benefit. A CPP child benefit is income for the child. You could have a child who has a part-time job. They could have net income. They could have other employment income. They could have tips. So it's not every circumstance. But very often, if your eligible dependent is your child, it is a better credit than the spousal amount. And you can only pick one. Okay? But you always have to look at, when you're doing this, make a list of all the possible credits that you can give. And then if some of them say this one but not that one, pick the best combination. So this is a place where you will be making decisions on a tax return, and you can make better decisions and you can make worse decisions. Okay, that's what it looks like. I'm going to show you the example of a son who has some net income, and that will give you the spousal amount or the eligible dependent amount. These are non-refundable credits. You'll get 15%. You know that because they go on a line that starts with a 3. In order to find out if you claim an eligible dependent, you have to do 3 things. First, you have to find out if the taxpayer can have an eligible dependent. Then you have to look at the dependent in particular, the one you're picking, because you might have a choice between a variety of dependents. You only get one eligible dependent. So look at the dependent that you're thinking of, find out if they qualify. And then lastly, there are a few situations where even if you have a possible dependent and the dependent can be your dependent, there's something that will prevent you from claiming them. So there's always a 3-step test. Now, if you had 2 or 3 possible eligible dependents and you do this and one of them is not qualified, but the taxpayer is, you can continue on and try the next one and try the next one until you get one. But if the taxpayer doesn't qualify, then stop what you're doing and don't waste your time. You're not going to get it. I know that this is messy. I know this is complicated. So what we have for you in the facts and figures book is an eligible dependent checklist. If this is hard to read because the boxes are really small and the text is really small on your screen, you can look in the facts and figures book, figure 28. I have these in my office. I print these out, and even after all the years that I have done tax returns, I really feel comfortable doing the checklist. I like to have done it at least once until I know my client's situation and make sure I'm not missing anything. So we're going to start with marital status. In order to have an eligible dependent, there must have been a point in the year when you were unmarried and not in a common law relationship, or if you were married, you were separated from your spouse and common law partner. Okay? If that is true, you're going to tick yes. If you hit a gray box on the checklist, you do not get to claim that dependent. If you hit a gray check here, you do not get to claim any eligible dependent. So this one is going to say whether or not you can do it. Okay? If you were separated from your spouse or common law partner, you cannot be supporting them or supported by them, but spousal support and child support that you are required by law to make because you have a written agreement or a court order do not count. So if you separate from someone and you're still financially supporting them out of the goodness of your heart, you're going to tick yes. If you separated from them and you can't stand them, but the court said you have to give them money, or because of an agreement that you made for various reasons, you have to give them money, then you can still tick no because you are not supporting them. So that one's a little fuzzy. We're going to come back and look at it again when we talk about separations and divorces. So for now, we're going to talk about people who've gotten together, they've gotten married in the year. There has to be a time in the year when they were not married and they did not have a common law spouse. Okay? Tick yes. If you tick no, you cannot claim eligible dependent for anyone. All right. Next we get to, do you have a dependent? For eligible dependent amount, for this line, a dependent is someone related by blood, marriage, or adoption. And it means uncles, aunts, nephews, nieces, no. Has to be child, parent, grandchild, grandparent, brother, or sister of you or your spouse. And child comes back to the definition that we had, which means any minor who is dependent on you for support and under your care, custody, and control. They are your child. So if you have someone who qualifies as a child, they are your child, even if they're not biologically or by adoption your child. Every other relationship here is going to be by blood, marriage, or adoption. So grandchild, grandparent, brother, sister will be blood, marriage, or adoption. Okay? The only exception to the child is if the child is in foster care, because if they're in foster care, you are not financially supporting them. The foster care program is financially supporting them. So foster children you can't claim as eligible dependent. Any questions about this? So there is a relationship that has to be there, and that relationship is is parent, child, grandparent, grandparent, grandchild, brother, sister. Think about Adam and Bob. Remember Adam and Bob? Adam was 22. He moved in with Bob because he was developmentally impaired and had to have some assistance, and Bob supported him financially. Would Bob be able to claim Adam as an eligible dependent? Adam moved in when he was 22. He is his nephew. His nephew on the list. No. He cannot claim as an eligible dependent. He might get a different dependent credit for him, but he would not be able to claim him as a dependent for eligible dependent. Okay. What if he had originally moved in before he turned 19 and now he is 22? In that case, he's not a nephew, he's a child. There's a parent-child relationship that was established, and it will continue. And while it continues, and Bob is supporting him, he will be supporting a child. So that's why that whole thing we spent takes precedence. That's why it becomes important, because this particular credit, they're only looking at what they call direct line, child, parent, grandchild, grandparent, and then they allow brother and sister. But nieces, nephews, uncles, cousins, no. Okay. Moving on. So now we're looking at a specific dependent. The dependent must be resident of Canada, except if they're a child. If they're a child, they don't have to be. Everybody else has to be resident in Canada. So remember I said at the very beginning, sometimes relationship matters. We've seen that relationship matters here. Sometimes residency matters. Here's a situation where residency matters, except for children. So the child does not have to be resident, but everybody else does. And then if the dependent was not a parent or grandparent, they have to either be under 18 or infirm. I will give you the definition of infirm next class, so we're going to come back and look at this again. But parents and grandparents can be an eligible dependent. Children under 18 can be a dependent. Everyone else has to be infirm in order for you to make the claim. Okay? Dwelling. You have to have resided in and maintained the dwelling in which the dependent resided. So you have to live with your eligible dependent to claim an eligible dependent. You don't have to live with them for the whole year, but at some point you have to live in a house with them. Okay? And then the fun one, there is one eligible dependent inside the roof of the house. So if you have a scenario where you have a child, you're a single parent, and you have a roommate who is a single parent, between you and your roommate under the roof of your house, one person can claim an eligible dependent. If somebody else inside the walls of your house is claiming an eligible dependent, you can't. So that's a fun one. Okay. So if anybody else in the same house where the dependent is claiming an eligible dependent, you don't get it. Doesn't matter if you're related. So Helene, good question. Doesn't matter. One per dwelling. This is a very valuable credit. They don't want to give more of them than they need to, and that is the rule that they have made. Okay, other restrictions. There are more. So we have determined that you have a taxpayer who qualifies because they were not married or in a common relationship at some point in the year and not supporting a former spouse or being supported by them. We have determined that the person has a relationship close enough to qualify. We have determined that they are the only one in the dwelling and that they resided with them, and they may or may not have lived in Canada, depending on if they're a child or otherwise. Now, the rest of the rules, you only get one eligible dependent, so you cannot have 2 or 3 or 4 eligible dependent credits, you get one. Every dependent can only be an eligible dependent for one person, so if somebody else is claiming them as a spouse or common law partner, they can't also be your dependent. They can be a dependent spouse or they can be an eligible dependent. They can't be both. Okay. If you're claiming a spouse, you have to pick. Do you want the spousal amount or the eligible dependent amount? You can't pick both, so you have to decide. It's one or the other. Okay. And then there's the really fun rule. If you are paying child support for the child you want to claim as a dependent, you cannot if there is a written agreement for child support. So written agreement for child support says I have to pay it. We'll talk about that more when we talk about separation. But if you are paying child support, generally speaking, you cannot claim the child you're paying child support for as an eligible dependent. There's a special rule about that. Because things are a little more complicated now, we have shared custody, child support might be going in both directions. If it turns out that because of this rule, no one can get the eligible dependent amount, then you treat it as if there is no child support and you get to pick who's going to claim them. Okay, so in a scenario where two people are paying child support for the same child, and that's the only child they can claim as eligible dependent, then nobody would get it. And that's not fair. So now we say, let's pretend there's no child support and answer the question again. So that's a special rule. This checklist is going to absolutely be the thing that makes sure you don't mix up these rules. So I highly recommend you get it. We're going to do a little bit of practice on this. I'm going to have to do this fairly quickly. So I'm going to annotate, but I'm not going to annotate all of you. I'm just going to do the annotation myself, and you guys can let me know. I'm going to give you an example of a house, okay? And I'm going to change this up a little bit. At the moment, we have two parents and a child. Can anyone claim an eligible dependent? Let's say for the whole year, two parents and a child. No. That one is nice and easy. What if, I'm going to do some little drawings here. That's not going to work. Try that again. What if dad was a single dad for part of the year, and then he either got married or moved his girlfriend in, who began to be a common law parent? In that scenario, can anyone claim an eligible dependent? Yes, dad can. Mom, who is the new potential mom, can't, but dad can. As long as nobody else is claiming that child as an eligible dependent. Now, can he claim eligible dependent for the child and the spousal amount for mom because she has no income? Nope, he has to pick one. Good. So that example becomes very important because you're going to have to make a choice. You have two options. Pick the best one. The best option is going to be the one you can get. So again, find out if that child is being claimed by the other parent that we don't see on the screen here. Remember, there may be another parent involved. If they're claiming the child at any point, you can't in that year. If not, you're going to look at who has income. The person with no income is the one you're going to claim. Okay. Good. Nice and easy. What happens if this is back to the original scenario where we have mom and dad and a baby? What happens if during the year something very tragic happens and dad dies? What option does mom have if she was widowed midway through the year? She can claim the child as eligible dependent. Depending on, this is the fun bit, the child's age in relation to when dad died. So if the child turned 18 and 2 days later dad died, in that case, can mom claim eligible dependent? So first the child turned 18, then she became a single parent, then no. If dad died before child's birthday, then yes. So you're going to use the checklist to go down and go, when was the separation and what were the conditions of the dependent at the time that they were separated? So all those conditions has to match. It has to be, if residency is an issue, you have to live with them while you were single. That's part of it. Okay. Always thinking about the marital status and the timing at the same time. Good. Let's try a much more common scenario where we're doing elder dependence. We have now 2 households and a child. So in this case, we have a scenario where there's a child, there's a dad, there's a mom. Mom and dad no longer live together. I'm mostly using gender stereotypes in this case just to make it easy for you to talk to me in the chat. Okay, this can be any family relationship, but we're going to do dad in one house, mom in one house, non-specified child in the middle. Okay, let's assume in this case that it is evenly shared custody. So the child lives half the time with mom and half the time with dad. In that case, who can claim eligible dependent? Okay, half the time with mom, half the time with dad. Who gets eligible dependent? One of them, not both. They have to pick. What can they do in this scenario that is fair? Because it's a big credit, but only one of them is going to get it this year. What will happen in real life in that scenario? They'll alternate years. This happens all the time. It's a real pain to deal with in terms of keeping track of which year is which. We end up with multiple files, one file with the child connected and one file with them not. They have to agree. This often gets written into separation and custody agreements. Who gets which years, odd years, even years, whatever. So they have to pick, but they have to keep it separate. Good. What if, I'm going to do a little bit of drawing here, if I can find my drawing tool. What if mom pays child support to dad? Now, who can claim eligible dependent? If you are paying child support, what happens? Okay, I'm going to go back to my checklist. Children supporting, where did it go? Is the taxpayer required by a written agreement to make child supports on behalf of the dependent? If mom is mandated to make child supports and I say yes, can mom claim the child as an eligible dependent? No. Because I hit a gray box. If she is paying child support because of a court order or a written agreement, separation agreement, divorce agreement, whatever, no, mom cannot claim eligible dependent. So that's where the checklist is going to help you, because if you say this makes sense to me, you might get it wrong. Doesn't matter what makes sense, it matters what the rules say. So we have a scenario. I'm going to go back here. I'm going to draw it back in again. Mom is paying money to dad. Now who gets to claim the dependent? Only dad. So he's going to do it because he can, and mom can't. Okay. Now, what if, take this away and put it way over here. What if half the year mom pays some support to dad, and half the year dad pays some support to mom? Now, what scenario do we have? It cancels each other out. Either one of them can claim eligible dependent, but not both. Now we're back to the original scenario where somebody gets the child, but not both. Okay. I'm not done because life is messy. And let's see what happens. Let's take support out of it. What if there isn't just one child? What if there are 2? Shared custody, 2 kids. What can we do now? Each can claim 1. Which child is more valuable? This is a terrible question to ask people. The younger child is more valuable because you get the eligible dependent for longer, unless, think about the caregiver amount that I haven't taught you yet, even better, the disabled child, because you get more. Okay, we'll talk about that more when we get to medical. The younger child or the child with less income. Sometimes the younger child has more income than the older child. They have to agree who is going to claim who. They don't have to claim the same person every year, but usually we don't mess around with it. So if we have the choice and you've decided that one person gets one child, the other person gets the other, it's easier to leave it alone unless there's a reason why they need to change it. But remember, you make the eligible dependent claim every single year. Good. What if dad is paying child support to mom? Now, how many eligible dependent claims do we have? Just 1. Only mom. Excellent. And if I had 3 kids, still just 1 in this case. If I had 3 kids and no support, it would be 1 claim each, because you can't have more than 1 eligible dependent. Are there any questions about these scenarios? I've got one more that I want to show you. This is not too difficult for simple families, but remember, families can be very complicated. There could be 3 or 4 houses in my picture, because there can be stepkids and half-siblings and all kinds of blended families, and you may have to sort of negotiate dependents out of a wide variety of possible options. So you always have to do the taxpayer first. Does the taxpayer qualify at all? If they don't, it's a moot point. Don't even continue. If they qualify, you have to look at all of the possible dependents they might be able to claim. And then remember, there are some extra family circumstances at the end. All right, let's talk about a different household, which is a very common household. Again, we might have 3 generations in one house. So in this case, I have grandma, I have mom, and I have baby or child. Okay. In this case, from mom's perspective, how many options does she have for eligible dependents? She's only going to get 1, but how many possible dependents? She has 2, because she has a parent living in her house. She is supporting them. She's providing them with shelter. They're resident with her, and they are a blood relationship. They are a parent. So she has 2 possible choices. In the ordinary course of things, who will be more valuable as an eligible dependent, do you think? Probably the younger one, because they have no income. Usually older people have some income. They might have old age security. They might have guaranteed income supplement. So we have to factor that in. Guaranteed income supplement is reportable for net income, but not taxable. Good. Excellent question from Helene. What if she was the mother-in-law? Still a mother, because it is the mother of yourself or your spouse. So she is a mother by law, although not by blood. Slightly more complicated if she got divorced before mother-in-law moved in with her. So that one gets messy. But if she was widowed and this is her mother-in-law, she's still a mother-in-law. So in that case, yes. Okay. And it does, like I say, life gets messy. These get messy as well. You can always make it more difficult. Good. Let's add some more complexity to this. And I have some notes here to make sure I'm doing as many different things I can think of. So we've decided that the child is generally better, but what do we have to think about that's outside of the house? She is a single parent, but the child has another parent. What might happen if this child has another parent? Dad might be claiming the child this year. So if dad is claiming the child this year, then mom has a choice. She can claim her mother. She can claim grandma. Okay, so that's something to think about. Here's another point. If grandma has a very low income and child has no income, but grandma is disabled, grandma might be more valuable than the baby. So you have to look at everything. Thank you, Nancy, for making that complicated. That happens. So when you have an age-dependent possibility, you want to look at all of the ones in front of you before you narrow it down to the best option. Okay? So there's the scenario. Now I'm going to have one more. Let's do a 4-generation household. What if the child, who is now, I'm going to say 17, has a baby of her own? Now, who can claim eligible dependents? Only one in the dwelling. That's the important thing to remember. So lots of people can claim lots of people. If mom is supporting her daughter and her granddaughter, she might be able to claim the granddaughter as an eligible dependent if she's financially supporting her. It means mom can't claim, or child can't claim grandchild. It gets messy when we start running into these, but one per dwelling. So that is important. And you'll see the example in the book. You might have siblings sharing a house together, and each of them might be a single parent, and you get to pick one age-dependent claim per household. So that is important. All right, good. We have made this as complicated as I think we can. I want to keep moving. We have talked today about 2 credits, just 2 of them. All of this has gotten us to think about dependents generally, but we've talked about rules for 2 specific credits, and that's the spousal amount and the age-dependent amount. We'll factor in child or caregiver later. Don't forget, this is something people forget, don't forget, eligible dependents don't have to be children. Eligible dependent can be an adult. So we do get into kind of tunnel vision, and as soon as the children turn 18, we go, you don't get it anymore. Look to the whole family scenario. Who is living in the house with you when you're thinking about eligible dependent? Who is living in the house? And that might open up some possible credits that you may not have thought of. Okay. I want to talk about other ways you can have a dependent, and we're going to use the terminology eligible spouse, eligible dependent, but with a different set of rules. So remember how I said you have to keep them separate? When we talk about different credits, the rules are different. This slide is not in your package. I created this slide for you to clarify it. What I will say that you can do for your own studying, because you don't have the slide in your package, there are 2 resources for you for Canada Workers Benefit. One is the Schedule 6 itself. If you look at a Schedule 6, these rules are very clearly explained. And even better than that, in our Facts and Figures book, we have a checklist. So if I can find my textbook here, and I go into my Facts and Figures, if you haven't found this book yet, I'm telling you, it is such a good book. In the checklist, you have a Canada Workers Benefit checklist. We've already looked at if the taxpayer is eligible. It also includes, do you have an eligible dependent? And do you have an eligible spouse? Eligible dependent for Canada Workers Benefit is different than eligible dependent amount. So wipe out all the rules I just taught you, fresh set of rules, and let's talk about it. An eligible dependent for Canada Workers Benefit is you or your spouse's child. It doesn't matter if you're married for the whole year. You can have an eligible dependent for Canada Workers Benefit. So you or your spouse's child who is under 19, remember eligible dependent was 18, Canada Workers Benefit eligible dependent is 19. So under 19 and living with you at the end of the year. So they have to be living with you at the end of the year. Doesn't matter if they lived with you all year. If they stop living with you before the end of the year, you don't get an eligible dependent for Canada Workers Benefit for that year. So at the end of the year matters. Timing matters for this one. And they have to be not eligible for their own, because if they're eligible for their own Canada Workers Benefit, they should claim their own and you get yours. If that is all true, you have an eligible dependent for Canada Workers Benefit on Schedule 6, you're going to say, yes, I have an eligible dependent. Okay. Then we have to ask, do you have an eligible spouse? So for Canada Workers Benefit, completely different than a dependent spouse, it is an eligible spouse. To be an eligible spouse for Canada Workers Benefit calculations, the spouse has to be resident in Canada for the whole year. So if your spouse was out of the country and then moved into the country, doesn't count. They have to have been here for the whole year. They have to be your spouse at the end of the year, spouse or common law spouse, so married or common law under the rules you learned today. They have to not be a full-time student. We'll talk about students later, but they have to not be in a university or college program for 13 weeks or more unless they had an eligible dependent. And eligible dependent here means the Canada Workers Benefit definition of eligible dependent, not the eligible dependent amount definition. If this sounds confusing, it is. You have to practice it. The rules for Canada Child Benefit keep them separate from Schedule 5. Keep Schedule 6 in one place and keep Schedule 5 in a different place. Okay, and they can't have been in prison for 90 days. So if you have a spouse who had a child and that child lived with you and your spouse on December 31st, and that child was not eligible for Canada Workers Benefit, and they were in school full-time, you still have an eligible spouse. If that is not true, and they were in school full-time, you do not have an eligible spouse. Follow the rules, use the checklist, and that will make sure that you are claiming the full Canada Workers Benefit eligible to you. You have to know this because when we get to the software, when you put family members together in the software, you are telling the computer things about those family members. You are telling the computer that the family member is resident in Canada for the whole year. You are telling them that they are not in school. You are telling them all kinds of things. And if that is not what you're supposed to be telling them, because it affects Schedule 6, you're going to have to make sure you do the correct data entry to let the computer know whether they qualify or they don't. So you need to know these rules really well. Don't get mixed up. Just like home buyer plan and home buyer amount sound very similar, but they are different because one of them is income, not taxable income, but it's income that has to go on Schedule 7, and one of them is a credit. When you see eligible dependent, it doesn't always mean eligible dependent amount rules. It might have its own rules. Okay? I want to talk about the provincial ones. Manitoba, the provincial ones are tricky. You're going to need to spend some time practicing them. So I'm going to start with the easy ones. We're going to talk about spouse or common law partner amount and eligible dependent on the MB428. And then we're going to talk about a few other ones. We're going to talk about the family tax benefit, and we're going to talk very briefly about the personal credit as well, the MB479. Okay. I'm going to do my best to get this done. Maybe we'll do a review problem. I'm not sure if we'll get a review problem, but let's see. Okay, so for this one, I would like you to take a look at, let's start with the provincial forms. And I'm going to start with an MB428. All of this you can find in your provincial supplement book. So the provincial supplement book is pretty good. It has almost everything we need. Okay. Manitoba tax on taxable income, we don't have to worry about, we know that. But when we get down here, spouse or common law partner amount, if you had a spouse who qualified for the federal credit, they might qualify for the provincial credit. The only difference is the federal credit allows them to have more income. So remember, the personal credit federally is usually $13,808, might be a little bit less if you're in a high bracket. Provincially, it's $9,134. So if they qualify, if they're on Schedule 5 and they're on the credits federally, you're going to put their income in here. And if you're lucky, they will still have a provincial credit. But if their income is between $9,134 and $13,808, they'll get a federal credit, but they won't get a provincial one. Okay, so take the income from line 23600 of their return. Most of the time, they're a dependent both federally and provincially, but it's tied to income, and the provincial credit is smaller. Does that make sense? Same thing for eligible dependent. If you had an eligible dependent on Schedule 5, federal form, they will qualify for this as well, but we need to know their income. So if you have an eligible dependent, you've done the checklist, you've put them federally on Schedule 5, take the same dependent, put their net income here, and see if you get an eligible dependent amount provincially. Again, most of the time, their income will be less than $9,134, in which case you're good to go. If it's between $9,134 and $13,808, you might not get a provincial credit, but you might get the federal one. Okay? The rules for a spouse are the same. The rules for an eligible dependent are the same. That's the easy bit. That's the bit that most provinces do. We have a little bit more. So the next one I want to talk about is the family tax benefit. Okay? For this one, you're going to find that your book is very helpful. But I'm going to open the form first. For this one, spouse just means someone you claimed a provincial spousal amount for. So if you're going to put an amount in here on line 2, you have to look at your MB428, line 58120. If there's a positive number on that line, if there's $1 or more, you're going to put it here. If it's 0, then you do not have a dependent spouse for the MB428A. Okay? Same one, if you have an eligible dependent provincial credit, if you have a positive number on line 58160, then you put that in here. If you don't, do not put it in. Okay? Now, both spouses can claim a Manitoba family tax benefit, but if they're going to do that, you have to decide who's going to claim the other ones. And Helene, yes, put the number. No, put the claim. The claim is 2065. So as long as you have a dependent spouse, add 2065. If you have an dependent, add 2065. So add the amount that they tell you to add. If you have no else dependent, but you have children born in 2003 or later, how many do you have? Times 2752. One child, that's what you put. Okay. But you can't claim a child twice. So if you have one child and they're an dependent, you're going to put 2065. You're not going to have a second amount for them. So that's important. And again, 2 spouses can claim it, but you can't claim the same child each spouse. So pick who is going to claim who. Normally that's not an issue. Usually it's better to have one person claim as much as possible because remember, this is being multiplied and reduced by 9% of your net income. And most of the time, if you have a dependent spouse, they don't need a non-refundable credit. So they're not going to claim anything because they don't need an additional credit. Their income is already lower than the taxable amount, in which case, if you have a dependent spouse, the higher income person is going to claim everything. You'll see how this works by practicing it. So you're going to get to start practicing it now. We'll see it in the review problems, and I'll show you in the review problems what it looks like. Okay. Again, I'm going to talk about age amounts later, and I'm going to talk about disability amounts next class. Can you choose between line 3 and line 9? No. If you have an elder dependent, you put the elder dependent in. You're already getting really nice credits for them, so you can't get even more. That's basically how that one works. Okay. But it is an excellent question. Dependent child means under 18, and they have a whole bunch of rules in the book. So I'm going to show you the book very briefly, because that is very, very helpful. Provincial, Manitoba. You'll find somewhere down here, Manitoba Family Tax Benefit. In order to claim the credit for a dependent child, the taxpayer must be the parent as the definition we've talked about. Child must have been resident of Canada and lived with the taxpayer on December 31st. They must be the only person claiming the credit for the child. No one can be claiming a spouse or common law partner amount for the child or an amount for elder dependent. And then no one has received a special allowance for the child under the Children's Special Allowances Act. Basically, they're not foster children. Marisa, federal, you can only choose one elder dependent, spouse, or child. For provincial, you can claim both. You can't claim both because provincial, you get it based on what you put on the federal one. So if you claim the spousal amount, you have dependent spouse. If you claim an elder dependent, you have an elder dependent. You can't claim both. So if you can't put it on the federal form, you can't put it on the provincial form. So it's going to turn out to be the same. But that's an excellent question because it becomes messy as things start to interact with each other. So you take the figures from the federal, look at the provincial, then you take the provincial figures and look at your MB428A and find out if you have additional claims on the MB428A. All right. And that leaves us with the refundable credits. I should mention one more. I highlight this for myself. This is not for you guys. But the rule for Manitoba Family Tax Benefit is that if you can't decide who's going to claim the child because they have shared custody, there is a default tiebreaker. Normally, the rule is you have to pick, just work it out among yourselves. If you both claim it, nobody gets it. For this particular credit, if the parents who are not together can't choose which children they're going to claim on their MB428A, the default tiebreaker says the higher net income person claims the child. So if they disagree and they can't work it out between them, the higher person gets the child. Okay. So that's one of those rules where when I have a messy family separating, everyone's arguing over who gets what and no one knows who put on what return, this is the one that I make a note for myself to say there's a special rule about this one. Okay. The book is very helpful. The last one that we have is the provincial credits. So I'm going to show you those as well. These ones are a little bit easier. Personal tax credit is by family. So if you have a spouse, you have to pick who's going to claim it, you or your spouse. We'll look at that when we get to our review problems as well. So we'll talk about that more next class. I'll do that at the beginning of class. Personal credit, $195 you get if you have a spouse. Doesn't matter what their income is. Doesn't matter if they are dependent or not dependent spouse. If you have a spouse, add $195. So this one is not tied to income, and it doesn't matter if you get a spousal amount or you don't. If you're married or common law, put $195 on. Children do matter. The rules for children is based on what's claimed on the MB428A. So if you've claimed a child on your MB428A, you will claim a child here. If you haven't, you don't. So if you have an ELF dependent from line 58160, you're going to add 195. If you have claimed a child on your MB428A, you will add that child in and get $26 for them. Okay, so that one, you have to get your MB428A correct in order to get this one correct. And again, most families, it's not difficult because most families, one person is going to claim the whole thing, and it's usually obvious who will get it. Either one person's income is too high that it doesn't work, so we give it to the other one, or their income is too low so they don't need it, so we give it to the higher income person. It's usually fairly clear, and they have a normal family situation, and that person claims everything. It gets messy when you have these complicated multi-family step parents and half children and custody shared between multiple different people. Then it can get messy. Okay? If it gets really, really messy, get help. If it's something that's kind of normal, then you're good to go. And Helene, are you allowed to ask to see a copy of the separation divorce agreement? We actually do, because we need to know what we're supposed to be doing. And they actually will talk about this. They'll have to register that separation or divorce agreement with the government as well in many circumstances. Not all of them, but if they want to get Canada Child Benefit, if they want to get GST benefit for their kids, now if they want to get climate action incentive, the government needs to know what their custody situation is. So they actually do, the government will ask for it, so we need to see it too. The one thing that's not in your book that I should mention in the 3 minutes I have left, climate action incentive. Climate action incentive we don't calculate anymore. It used to be we had to make decisions about spouses and dependents for climate action incentive on Schedule 14. We don't do that anymore, but you should be able to tell your clients what the answer is. And unfortunately, this has not made it into the provincial book yet because it hasn't been updated. We're going to see if we can get it added before the end of the course so you have it there. But the rule for that one, I'll go in more detail when we get to separation. If you have shared custody, what the government will do is they'll look at every child that's registered to you. So if you've registered your child for Canada Child Benefit, they'll look at the same children, and they'll look at each family, and they'll calculate what 50% of what you would get based on your claim. So if shared custody, you'll usually get half for each of your kids for Canada or climate action incentive in Manitoba. This is different from how it used to be. So if you did it when we had to do the full Schedule 14, we had to pick who was going to claim the children. Now that the government is doing it themselves and they have tied it more to the benefits department, it's going to be a 50-50 split depending on who has custody, and that we can at least tell our clients what to expect. All right, good. So we did not do the review problems. We will do the review problems at the beginning of next class. Take a few minutes if you haven't done it yet. Go through the review problems and try them, especially the provincial forms, because the provincial forms are going to be necessary. And I'm going to tell you, next class we do medical expenses. Equally difficult. There's a lot of rules in medical expenses, so spend a little bit of time if you haven't done it looking at all of the complicated things. Try your exercises, and we'll spend more time on that. So we'll do review problems and we'll do exercises. And I'm just going to stop sharing, and I want to make sure that you know as well, self-test number 4 is not far away. So you're going to complete your exercises for next week, review problems, and then by next week, we're doing another self-test already.